to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And Bill Bullington's here with Michael Seeger.
Hi, thanks for having me back.
No problem. Yeah, Mike is going to be the partner, and he's going to be the guy that runs the Lookout for the Bull website, so you should probably get used to his voice. And we were just talking about this on the way over here. This is going to be so much fun, and I think that tools have improved so much for us that I'm really excited about it. Excited about the economy. One of the reasons that stocks are doing so well right now is that the economy is doing very, very well. You can say it's the longest expansion. Yeah, it's also one of the slowest. So I think probably the slow and steady I'd prefer over the really fast and volatile.
Tortoise beats the hare.
Yeah. And we are a long way, I think, from maximizing. The economists that I follow that read and write on a daily basis are of the same opinions. And I'd be remiss to say that I'm not influenced by them, because I am. And but I've chosen them because of their long-term track records, their outlook. They're very practical people, and so I like what they have to say. And they have contacts in Washington that I don't. So there's an awful lot of good stuff there. It's a good time. This is a very good time to be an investor. And I think people will look back, 10 years from now and go, wow, I really wish I would have paid more attention. Because, there's an awful lot of stuff to be afraid of. Fear sells in the media. I don't know, most people have probably heard, if it bleeds, it leads. Those your leading stories, if they've got blood in them, all the better. Because that gets people's attention. But bottom line is, the economy is actually doing quite well. Stocks are doing very well. It's a little easier to make money right now than it has been in the stock market. Now, having said that, market probably crashes. I'm probably the one that will be blamed for for that. But you got to realize something that we keep talking about on this show, that when you have a fractional reserve banking system, monetary system, and it's independent, which is a very key. Trump cannot order no president can order the Fed and tell them what to do. Congress can't do it, and neither can the Senate. Now, they could all get together and pass new laws. Good luck. And you need to leave it alone, because it does very well. And these guys have the ability to adjust on the fly. So when they see something coming, or when something happens that's unexpected, they can adjust. And that's why stocks are so much higher. That's what actually it's part of the whole picture, is that, inflation kind of creeps in, and the companies causing inflation, guess what? They're the companies that are selling you the food, the gas, the cars, the houses, the clothing.
Necessities.
Yes. And that's why those stocks, those companies have a tendency to do better, because they aren't going to take the rising inflation on the chin. They're going to raise prices, and they'll try to cut their expenses. So they've got a lot of options available. The Fed's got a lot of options available, and this stuff really works. It works very well. And around the world, the United States was one of the few. Germany, England, and the United States. Okay, we all used the fractional reserve banking system. Italy used it somewhat. There were some other countries that were using it. And it's one of the reasons that, out of the top 10 economies in the world, all of them have a fractional reserve. So you got to figure that they're probably onto something, and we didn't invent it. We copied it. So it's a good thing. It's a self-healing mechanism. Now, the rate of healing is affected by what they do, and it's affected by government spending. It's affected by taxes. But the bottom line is, sooner or later, it heals. And so far we don't have any real big problems that have popped up yet. I guess these are kind of the garden variety of problems that you always have. And When you get lots of large losses by banks, that's a big problem. That's when markets tend to go down a lot. It takes them a long time to recover. Eventually they do, because again, they're going to make the corrections. They're going to circulate the money. They'll pump it back up. That's basically how it works. So, and you're probably studying a lot of that stuff in school now.
Yeah, a lot of the macroeconomics is all about this sort of thing, the fractional reserve and how different nations control their economies or maybe don't control their economies.
Yeah. It's really interesting. I did not know this for years after I got out of college. But if you want to find out really good economic data on a country, go to the CIA's website. The CIA actually tracks the economic data of every country.
That makes a lot of sense.
Yeah, I know. That's what I thought when I first realized it. I was like, wait a minute, what? The CIA? And then oh yeah.
It's kind of pertinent to them, isn't it?
Yeah. So it's pretty cool. And a wealth of information there. It's amazing. And the coolest part about this is back when I was in college, the reason I didn't know that is because Al Gore had not invented the internet yet. And once that came along, and I got to stop using that joke. It's way too old. And actually, none of the millennials know who he was. I mean, some of them do, but the vast majority of them don't. And well, I shouldn't say that. A lot of them don't. But anyway, so look out for the bull. It's we got the names reserved. We've got the email set up. We got a designer coming in. We've got actually two designers, but I'm really looking forward to it. I haven't set the date, the official date for the next seminar, but it's going to be sometime maybe a week or two after Labor Day. People get, things start settling down. The temperature starts to drop a little bit. Yeah, man, I can't imagine doing a seminar in that building with all the sunlight that hits it. No thanks. That would just be hot. I'm not sure the air conditioners are capable of cooling that big of a space in a fairly short time period. But if you have a question, by the way, that sometimes I've been traveling a lot, so I've had to pre-record the shows. Today is a live show. You can call us at 216-901-0945. That's 216-901-0945 if you have a question. You can also go to my website. When we put the next seminar up, you can sign up there for free. If you want to get together for a Get Acquainted meeting, there's no charge for that. So you can just reach out on the website, give us a heads up, send us an email, and we'll be glad to try to set something up for you. I'm not sure what kinds of questions you might have. That's one of the fascinating things about my business. Everybody's different. I mean, everybody is different. And husbands and wives, it's amazing how many married couples have totally different views on investing and finance. That's amazing. I would recommend just, having 30 years experience, you may want to discuss that with somebody before you get married. It's a good idea. It's not always necessary, but in most cases that you're on the same page financially will really aid your goal of having a nice marriage. And what I'd like to do is to make the joke, are you married or are you happy? Obsolete. I like to just push that out. But a big part of that is financially being on the same ground. Most of what you learn in this business actually can be boiled down to stuff that's relatively simple. Problem is you have to learn the complicated stuff to know which ones that you actually need and which ones you don't. So you have to know how something works to know whether it's effective or not. Okay. And there's a lot of effort into learning a lot of stuff where you go, oh, okay, that's nice. And that'll come into play maybe once every 1,000 times. And if it ever does, I'll know that. But it's not really necessary in mainstream finance. You don't really have to know that too much. So, but that's for people like us to have to know so that you don't have to. So that when you ask that question that comes up 1 in 1,000 times, it's, you know the answer and you can kind of explain what you're doing and why it is or is not that pertinent to your situation. I'm going to take a real quick phone call right now. I got Joe. Joe, you're on the Bullington Capital Report.
Yeah, I was wondering if you could just talk about some of your past stocks you talked about.
Which ones?
Are you there?
Yeah.
I'm sorry. Salem and Rail.
Oh, you like the losers. I thought you were going to yeah, I still have Salem. Salem owns this radio station, by the way. Dividend yields really high. They have substantial debt, but we talked about that from the get-go. And why didn't you ask about Discovery Financial Solutions, which is up over 50%, or Procter & Gamble, which is up 75%?
Okay, I mean, I still have Procter & Gamble. I didn't get Discovery Financial.
Okay.
The Procter & Gamble one's a good one.
And by the way, if you were to look into your funds, you're going to see stocks that are down 70 or 80%. You're going to see other stocks that are up a couple 100%. That's just how they work. And if you didn't know that before, now you do. But that's just how stocks work. And whenever I'm buying stuff like this, I am not putting a lot of money into it. The vast majority of my money is in a fund that's run by an algorithm, basically a mathematical formula that I'm familiar with. That's where the vast majority of your money belongs, is invested that way. So I could actually lose money on 9 out of 10 of the individual stocks I pick, and it will have no impact on my life whatsoever. And that's why I'm so smart alecky about it. That's why I'm not worried about it, because it's not a lot of money for me. And I, everybody I talk to, how much should you have in one stock? You never go above 5%, and as far as I'm concerned. You put more than 5% of your money in one stock, you're asking for it. I don't care what Kramer says. You are not diversified with 5 stocks. That's not diversification. That'll get you killed, especially if you have Salem and Rail. If those are your 2-5, you'd be in big trouble. So anyway, do you have any other questions for me?
Well, I'm just wondering, have you heard anything new about Salem?
I have, and I really like them. I got to be really careful, though. They own this station, and this could be considered insider. I can promise you I've never spoken with the CEO personally. I don't know the controller. I never repeat anything that hasn't been already written about these guys. But I can tell you that, so they own The Fish, 955thefish.com. I do a lot of advertising there, and I can tell you that it's actually been the best advertising that I've done. And I've done a lot of stuff. I've done television, radio, the magazines, newspaper. And for me, The Fish has been the best. So I didn't put enough money in that stock to jeopardize, even though I really like it a lot, and it's really helped me out in my professional career. Actually, and it just makes me feel better. I don't know if you've ever listened to The Fish, but it's a pretty good station. It's the only one I even listen to on FM anymore. But so all that stuff, and the stock is still down about 75% from where I bought it. But see, I learned not to fall in love with any company, because there are things that can happen that you just can't control. You can't control it.
All right, how about the questions? Would you buy some more right now?
Yeah, and in fact, I may go on. I'll probably do that. Mainly because it's got a huge dividend. They're generating a lot of cash flow. Here's the risk: they have a lot of debt. This station has a lot of debt. They need to be able to pay that and cover their interest expenses. And if push comes to shove, if advertising revenues, which can be very fickle. Okay, that's the other thing. That's the other reason that I didn't load up on it, is because I know the industry. When the economy starts going back, the thing people cut first is the advertising budget. They always have, probably always will. Okay, but Salem's doing a lot of other things. They're doing a lot of really smart things, I think, to improve their customers' experiences. That's incredibly looking into the future for them. I forgot what the word for that was. They're actually looking into the future and getting involved in digital marketing, which I think is the way of the future. So they're actually trying to meld the digital marketing platforms with the radio, the regular broadcast radio. By the way, the people in the country that have the most money, they're above the age of 65. That's where 50% of the wealth is concentrated in the hands of people above the age of 65. They still like the radio. They still like radio. So they don't really care what comes across Bluetooth on their iPhone, and they probably don't have an iPhone. They're listening to the radio. And FM's a better signal. It carries really far. The technology is improving on that. They've got all. It's just. I think they're making a lot of good moves in a very, very tough industry. The industry itself is, it's been under attack because you can carry your smartphone around, you can sync it up with Bluetooth, you can get Pandora through your dashboard. It's tough. So that's why I didn't load up on it, but I do like it. And now that you brought this up, I think I'll cut my average cost down by about 75%, about 60% or so, and just add some shares to it. But I have to, again, I have to tell you, you do this at your own risk. They do have a lot of debt. I don't know anybody in the upper management of this company other than what I've read online. And I just really like the company. So, but I learned a long time ago, most people really like a company and they'll invest solely based on that without ever looking at the numbers. I knew the risk before I ever bought the first share. And I knew it was that's why I don't have a ton of money in it. But
do you know why Rail cut their dividend?
Yeah, because they're not selling as many cars as they had been selling before, rail cars, and that's been a real problem. That's a huge problem. They still have a lot of cash, but it's got financial difficulties. Stocks normally don't go down for no reason whatsoever. Stocks either overpriced and just going to normal, or it's got financial difficulties, economic difficulties. That would be both of those are in the category of economic difficulties. Rail builds mostly cars for coal. I'm not sure how much longer we'll be burning coal. And I thought, that they were going to use some of the clean coal concepts, but evidently the utilities don't want to spend the kind of money it takes to build those plants. They'd rather build a dam to keep back all the ash and watch it break. Because it won't break for another 30 or 40 years.
And they'll be out of office at that point, right?
Yeah. So just because somebody should do something doesn't mean they will. And that's one of the things that's really frustrating about being in this business. Because we get to hear things, we get to learn things that are happening that every major problem the world has minimally 5 viable solutions that would wipe that problem out. At least 5. They almost never get done. Occasionally they do. But hey, Joe, I got to take a real quick commercial break. You're welcome to hang on if you'd like to.
No.
Oh. So you're listening to Bill and Mike. We'll be back right after these commercial messages.
Baptized this time, dark skies leave me capsized.
And you're listening to Mike Seeger and Bill Bullington right here every Saturday morning. Well, at least I am. Mike probably will be one of these days. Yeah, as soon as he graduates.
I might stick around. We'll see.
And anyway, I'm going to go right to the phones. If you'd like to call in, 216-901-0945, 216-901-0945. And Phil, is this Uncle Phil?
Uncle Phil on the phone.
All right. How are you
Phil,
doing?
Good, thanks. A few months ago, you made a pretty big change, I think.
Yep.
Switching out of the dividend model, which was fine,
Right.
into which is 40-some stocks, and now you have 2 ETFs, which is like 1,000 stocks almost. You want to walk me through why you did that? And I'm
Sure.
happy with it, and obviously it's performance-based. I'm
Yep.
thinking you thought you'd do better,
Right.
but talk to me about that a little bit.
Yeah, actually, the 2 models I picked for that, they're called the Russell Value, Mid-Cap Value, Russell Mid-Cap Growth. And when you put those 2 together and you rebalance them on an annual basis, the performance has been one of the few things that's actually kept up with the S&P over the past 5 years. If you go back even further and you look at that over the past 10 years or even 15 years, it's had really good results with lower volatility than the dividend model. So if you can keep the returns and eliminate some of the volatility, some of the fluctuation, I think that's a good thing to do. And so that was really the reason. Now, the way that those funds are selected, by the way, putting them together like that was actually better in my testing than just buying the Russell Midcap Index. It actually ended up smoothing it out more so than just buying the regular old index by buying the value-oriented one and then the growth-oriented one. Now, the growth-oriented one has a momentum factor built into it. So, like, a lot of people were asking, because I took the momentum model and replaced it with that too. They're going, why did you do that? Well, because we would be duplicating a lot of the same stocks. There's a momentum factor built into that growth model. Makes me kind of nervous because those are aggressive. You know, they're running. When that thing's running, it's really running. When it's crashing, it's really crashing.
Yeah.
But that's where the value-oriented stuff has a tendency not to fluctuate quite as much. And so if you want to try to time the market without timing the market, because doing that by looking at a chart or reading the news, hearing the news is impossible in most cases. And I'm going to say, when I say most, I'm talking about 999,999 out of a million. Okay.
Okay.
But if you look at basically the risk adjusted performance on that, it's just been really, really, really tough to beat. And here's something else. I just learned this. I mean, I thought I was done with school, 30 years ago. Sorry.
Sure.
Still learning. So the ETF industry lobbied Congress, and I was not even aware of this up until just recently. Okay. But when you have an ETF, you only get taxed, and many of them work this way, not all of them, but you only get taxed as a long-term capital gain as long as you've held that for more than a year. The vast majority of them you're only going to pay long-term capital gains taxes when you rebalance your portfolio. So if you wait for a year and a day or a year and 6 months, you're going to get long-term capital gain tax treatment on that. If you're doing mutual funds, you may get a capital gain distribution. And typically when the market's down a lot, you get a capital gain distribution. And a lot of those are going to be considered short-term gains because somebody that just got in there less than a year ago and pulled out is going to cause you to have to pay more taxes.
Yeah.
And that's a big deal. I mean, that's a really big deal. So
all my money is tied up in debt or in IRA type accounts, so it doesn't affect me too much.
Oh, that's great. That's awesome.
Yeah.
Yeah.
That's number one. Number two, previous caller, a couple of mentions I have to give you. Remember driving home from Tennessee several years ago, and not JC Penney, but Disney, which you suggested, was about $25.
Yeah,
now it's about $140.
Yeah. There's
another one I remember, Jazz Pharmaceutical.
Yeah.
I think you suggested it under 20.
Yeah.
I don't know what it is now. I think it's over 100.
It's 138.
Nice.
But all these things were stocks that I either just bought a small amount in or I had a trailing stop on them. So I'm not real emotional over the stocks. I just don't allow myself to do that because they're like bad lovers. Sooner or later, they're going to disappoint you.
Yeah,
that's really crappy analogy.
As I'm the elderly now, I used to really enjoy messing around with individual stocks.
Right.
And even the ones I own, I think I'm around 3%.
Right.
As far as weighting.
Sure.
Is that like a normal thing for
that's a good one.
Older folks?
Actually, that from an institutional standpoint, you'd be considered aggressive because you got 3%. But institutions, they put 0.75% in hundreds of stocks.
Right.
But no, 3%, that's pretty good. I wouldn't go much more than 5%. If something gets up over 5%, it's okay to keep it. When it gets over 10%, I'd cut it back. I would just cut it back. But
yeah, well, you're doing a great job, I think.
Oh no, I think you're doing a great job because you stay. I've known you now for a long time. You have a really cool head and a good positive demeanor, and that's why you're successful investing. It's psychological.
Thank you.
Yeah.
All right, pal.
All right. Well, have a good weekend.
You too, buddy. See you.
Yep. Bye-bye. Yeah. I think you learned that from being a fireman. Because being a fireman, you're going to run into a burning building. You got to have a little bit of nerve for that. Thank goodness for those guys. They make pretty good money too, by the way, and they earn it. They risk their lives literally every time you run into a burning building. So it's pretty cool. And by the way, the people in the fire department in my place will come out and put up your smoke detectors for you for free.
That's nice.
Yeah, I didn't know that. I'm trying to pay them. They're like, oh, no. It's pretty funny. Mine are high. I have a 20-foot ceiling, and you get, man, the ladders, you got to have to get up there. It's pretty rough. Anyway, so hey, Mike, was there anything that you thought you might want to talk about?
I remember you mentioned something before the show about how it's been roughly 18 months since the market's seen any, what did you call them?
Flash crashes.
Flash crashes, that's right.
Yeah. It's been quite a while. And flash crash is when you see the markets go down a lot in one day. And I don't mean like a 3 or 4%. I mean like a over 5% in one day. We had one 5% drop. I'm sorry, no, it wasn't 5%. We haven't had the 5% drop. We had a 5% recovery day. Now think about that. So back near the end of December, okay, it was actually December 24th. It was Christmas Eve.
Christmas Eve.
So it makes the low for the year. And the next day that the market was open, which was the 26th, okay, the day after Christmas, it goes up 5% in a day.
Merry Christmas.
By the way, if you missed that 5%, because it's not the 5% that you missed,
mm-hmm.
It's the compounding on the 5% because it's up nearly 30% since then. So 30% of 5%, you cost yourself 1.5% of your total by missing one day. And that is amazing. And I did have, I am never allowed to, by the way, I can't talk about anybody's financial position, what they do. I can't even discuss it between spouses unless they have a letter on file that says it's okay. Now, we're allowed to talk about it if they're sitting there in front of me and they're okay with that. But if somebody gives me the high signs and shakes their head, I have to stop talking. That's pretty wild. You have to get stuff in writing. So I can't really disclose this person, but we had someone that we know very well who sold at the low of the bottom, managed to capture within a quarter of a point, a quarter of a 1%, the low, and then missed the rebound. And, it's the old saying, you can lead a horse to water, you can't make him drink, especially when the water keeps, gyrating. But it's hard. All of finance is literally, it's psychological. I should say 95% of it. 5% is technical. And by the way, it doesn't sound like a lot. Well, you're talking about hundreds of thousands of pages, so 5% is pretty good. There's a lot of stuff in there. But the 95% of it, though, is really don't do anything really dumb. Try not to. Try to learn to avoid those things. And if you just avoid making the big mistakes, you're fine. One of the biggest mistakes that people make, investors make, is they look at the past 1, 3, and 5 year track records, or even 10-year track records, without knowing how those were achieved. That is telling you nothing. All it's telling you is where they've been. It doesn't tell you anything about what it's going to do in the future.
All of the effect and none of the cause, basically.
Right, exactly. That's the biggest mistake you're going to see people make. They're going to judge their investments based on performance without knowing how that was achieved. If you don't know how it's achieved, you're not going to know how it's going to get repeated. And just looking at the numbers, it's totally useless if you don't have other criteria that you're adding to that. The ones that, and by the way, the ones that typically have done the best are the ones that have just gone up the most. That's just what you want to do, right? Buy something that's just shot up a mile. And that's when you want to, and that's what happens. The average investor looks at that and doesn't know why. They don't even know why, because it seems to make common sense. Well, just buy the one that's got the best track record. Well, yeah, it's actually a little more complicated than that. Not a lot, but it's, it's like leaving the sugar out of brownies. It's just one ingredient. Why should that matter? Well, you like the taste of cocoa with no sugar in it, and by all means, go ahead and do that. But you leave that out, or leave out yeast from a loaf of bread. You got a pancake. It's not going to rise. And by the way, the amount of yeast that you put into a loaf of bread is incredibly small. So it's just like that with investing. There are factors that matter. They're relatively small. In the grand scheme of things, it's not a lot of stuff. Here's a factor. I talk about this almost every day. How much can I take out from my investments? Well, they don't actually say that. They say, well, I need this much money to live on. And normally it's like 40, 50,000, something like that. Well, how much do you have? I have 100,000. Wow. See, I'm not allowed, because I'm a fiduciary. I'm not allowed to tell you that it would be safe to take out more than 4 to 6%, which is $4,000 to $6,000 on 100,000. That's the range, and it depends on your age, mostly your age and your risk tolerance, but your ability to handle fluctuation. That's what risk tolerance is. So if you're looking at that, for every $100,000 that you have, you should be limiting your spending to somewhere between $4,000 and $6,000 a year. That's not a whole lot of money. On a monthly basis, that's, you're talking about $350 to $500. And they need to start teaching this to kids when they're 12. When I was 12 years old, I knew enough of the math. I could do the percentages. And then I would say, wow, so if I wanted to have, let's say I wanted to have $100,000 and I was going to take out 5% a year, I would need $2 million? Yep. That's the math. And it's so disappointing that they're not teaching that. And we may have to do something about that. I was thinking about putting together a game that you could have 11 and 12-year-olds play that would kind of drive that point home. I would have got it. I know I did, because I had a paper out. I could do percentages really well, but back in those days. Anyway, I got to take a real quick phone call. If you'd like to call us, 216-901-0945. And I got Walter. Walter, you're on the Bullington Capital Report.
Hey, Bill.
Hey.
I don't usually make market predictions, but yesterday I was looking at PBS, the stock market show, and I was looking at the Treasury bonds, 5, 10-year, 2-year notes.
Right.
And when people say, you always hear this, how's the stock market going to do in the future? I was looking at the Treasury notes, and I thought to myself, I don't make predictions usually because I don't know, but the market should do okay, and for this simple reason. Banks and Treasury bonds are paying basically nothing.
Right.
So I mean, the other asset class, what the stock market does is in direct correlation to what the other asset classes are paying, and they're paying nothing.
Yeah, actually, the correlations will stay pretty highly correlated for a long time. Eventually, they kind of diverge for a while. So the correlation's not like 100%. It's more like 0.7 on certain investment vehicles. Most correlations are actually a lot lower than that. But you're right. That's what I've been talking about for a long time. How are you going to retire on a CD that's paying less than 2%?
Absolutely.
Yeah,
I mean, a 10-year Treasury bond's paying 2% even.
Right.
That's nothing.
That's $20,000 on $1 million. You got to have $1 million to get $20,000. By the way, you're going to pay taxes on the $20,000. So you're probably going to get about $1,500 a month if you have $1 million, if you're going to invest in treasuries. And it's one of the things I struggle with a lot. And there are a lot of products out there that people are pitching to people that sound good, that also are not going to pay very much. An equity indexed annuity. If you want to invest in an annuity, look for an investment-only product. There are a handful of them out there. These equity indexed annuities, they're just not good. You just won't make money on them. And,
I hear the commercials by one particular person all the time on those things. I agree with you.
Yeah.
The thing that gets me with those, like you said, equity-based annuities, the thing that gets to me is he's promoting something that's tied into the stock market, and then he's promoting fear of the stock market.
Right.
Yeah. I mean, does that make any sense?
I'll have to talk about it after we come back from these commercial messages. You want to hang on, or?
Yeah.
Okay. All right. Thanks. You're listening to Bill Bullington right here on 1420. We'll be back after these messages.
There's peace inside, but still you're searching for someone who understands the pain you've been through. What the Father waits with open
back. Hey, Walter, you still there? I guess. Oh, hey. So, do you have another question for us?
Yeah, I got a investment story involving someone else to kind of as a lesson to your audience. I have a friend, he's a great investor. His sister-in-law called him about some investing advice, and she wanted to know how to roll over something into an IRA from work, 401k, that kind of thing.
Sure. Yeah.
Technical thing.
Right.
And he was explaining it to her, but he says, she didn't quite understand his explanation, so he says, I could tell she wanted her handheld. So she went to an accountant, CPA, where she lives in Mentor.
Okay.
And while she's there, he was selling her on a mutual fund.
Okay.
I think it was Massachusetts AA or something like that.
Yeah, we
Don't get me exactly right on that.
Yeah, we shouldn't name it anyway. That's good.
Okay. But in the end, she had like $300,000 to invest. She doesn't know much about investing.
Right.
And she called him back and said, should I do this? And she, according to him, she had the check just about written to put in this fund. This guy really sold her. He says, I'm rich because I do this kind of stuff. I know
Sure.
the inside and out. And he said that to get into the fund, she had to pay like a 5% front-end load. And he warned her, don't do that. He says, you come in with $300,000 and within an hour you're down to $285.
Yeah, that's an old fund, and if it's got a 5, I can't imagine because there's normally a break point at $250,000. I'm not even sure they're allowed to do that anymore. But but it is a lot. The front-end loaded funds are a lot. If you've got a really good fund, it's got a long-term track record, eventually they may close that gap, but there are a lot less expensive ways to do that. I'm a big fan of exchange-traded funds because not only one of my custodians doesn't charge a commission, they only charges $5, but the fees are much lower on that kind of stuff. So that's my favorite way to invest. Plus, they tell you exactly how they're managing the money. Exactly. You can find out exactly how that money is being managed. When you're investing in a fund that's run by a management company, they kind of tell you what their goal is, but you really don't have any idea of what's in that fund because the manager has discretion. That means they can pick and choose whatever they want. And you better hope the manager doesn't get divorced because that's really going to change his mindset.
Yeah.
Or her.
Yeah.
It's just a people thing. I don't know. I'm what people refer to as a quant. I like quantitative stuff. Like there are certain factors like profitability and dividends. Somebody was calling in earlier talking about the dividend yield. There's a new fund, and I don't have to do a lot of background research on this because I know Russell and I've done a lot of testing and I know these factors that profitability, size, and the fact that you pay a dividend, those are 3 factors that count. Volatility, beta, throw that out the window. It's garbage. Okay, they don't work. The size, profitability, and a dividend, you give it enough time period, it has had a tendency to work, and there are good reasons for that. Companies that are profitable and are increasing their profits should go up. You know what I'm saying?
Yeah.
And a company that's crashed, who's going along the bottom, who's bouncing along the bottom where the volatility gets low, you're putting it in because of that, and that company could have a boatload of debt. That doesn't mean it's a good company, but that will make the low beta program if it stays in the basement for a couple of years, right before it stays in the basement for 10 or 15 years before they go bankrupt.
Yeah.
So there are certain factors that actually that matter more than others, and when I see that and a fund comes out like that, I'm going, yeah, that's a really good thing. But it takes a while to be able to figure that out, and I just feel so bad for the public because there's so much information now. And when I first started, there were only 1,500 mutual funds. That was it. Entire country, 1,500. Now there's 60,000 in my database. There are only about 3,000 stocks big enough for them to invest in, which is really wild.
One last question on the stock market-based annuities.
Sure.
The thing that he never talks about, I listen to this guy occasionally,
Yep.
is that when you have a good year, like this year so far has been a good year for the market, right?
Yep, right.
It's up about 20%. you're not going to get that gain
No.
in a stock market-based annuity. You
No.
get a partial gain, don't you?
A super small portion of it too. And by the way, it's done on a monthly basis. They recalculate that month to month. So it's not like you're going to get 60% of what you made in the first 6 months. You're going to get 60% of what's made in one of those months. And it's just I would stay away from those. They're called equity indexed annuities. I'm not a big fan. I'm just not a big fan. Investment only, good. There are two out there that I really like a lot. The expenses are super low. You could not get those if you were to buy them on your own. You get institutional funds, which you normally have to have $1 million per fund to qualify for, and you get access to those with $15,000. So those I like, but the equity index, not a big fan.
Okay.
But anyway, hey, thanks for calling. I need to get this other guy's call. He's been holding for about 15 minutes here.
Thank you.
But thanks for calling. Yep. JR.
Hey, good morning, William.
Hey.
I have closed out my positions in Beyond Meat in advent of Monday's earnings report.
Okay.
And I'd like to hear a discourse on the old saying, buy on the rumor, sell on... Was it buy on the rumor, sell on the fact? Is that correct?
You know what? There's a saying that's similar. There's a saying that's similar to that, but there's also a saying that says buy in May, go away, don't come back till November.
I've heard that one also.
Okay, well that would kill your returns.
Well,
it's right until they're not, and then when they're not, then you feel really bad.
Nobody has any idea what's going to happen on Monday, but should the stock get hammered, it's going to have to get a new re-entry point, is it not?
Well, here's the thing. Beyond Meat, and I read all about the company. It's been asked to me by a bunch of people. The revenue past 12 months has been growing like crazy. It's up to $100 million. So they go from nothing 3 years ago up to $100 million bucks. That's a really fast growth rate. It's selling at $14 billion.
I know it's absolutely insane.
Okay, that's 100. Let me tell you something, Jerry. If somebody offers you 140 times your salary to buy your job so they can show up and do everything you're doing every day and get paid what you're getting paid, if they offer you 140 years worth of your salary in a day and you don't take it, you are never allowed to call back into this radio show.
It's absolutely insane. I agree, but there's got to be some money to be made on the insanity of others.
Well, if I were to have to take a flyer, because and Mike and I were just talking about this. You know who Isaac Newton is, right?
Of course.
Okay, so some of my reading online, so I can't verify this, was that he actually was able to calculate the light speed of light before they had computers. Okay, so if that's true,
that's pretty heavy.
He's pretty smart, right?
Yeah.
He lost all of his money in the Dutch tulip bulb craze.
Yeah.
And he had a good sense of humor about it. He wrote, I can calculate the movements of heavenly bodies, but I fail to calculate the madness of men. That's what he said. That was his only comment. I was like, exactly. And basically, Beyond Meat is a tulip bulb. And your guess, as good as anybody's, at when it's going to finally come back down to earth. Now, if I wanted to make some money on this, okay, I would go buy a long-term, out-of-the-money put. Okay,
I would buy a put, huh?
Yeah, I would buy a long term. I'd actually buy a leap, and I would probably take the leap out. Maybe the stock closed at 234. I would probably look at the leaps that are around 150. Okay, because this stock's not going to go down 50%. This stock's going to go down 80, 90. Okay.
No, I would assume so. Sure.
Yeah. Just
80 or 90 from where it is today.
Yeah, just to get down to a more reasonable level. Now, the company itself has a great story, by the way. I mean, this story is phenomenal. In fact, when I read the story, I was like, oh, man. And then I went back and looked at the numbers and go, oh, nope. But
it really is fascinating what's going on. It's unbelievable that it will keep on going at the rate it has, of course.
well, it will until it doesn't. And unfortunately,
There's got to be all good things must come to an end, as they say.
well, you might pray real hard. That maybe you'll get.
All right.
Maybe you'll
I
get.
just wanted. Well, it has rewarded some people quite well, but
Oh yeah,
the smart ones
yeah. So
getting
did
out of
Amazon.
it.
Right before it went down 95% and took 10 years to recover.
Yeah. Well, that's
Hey,
really good.
thanks for calling. Though I hear the music. We gotta take off.
All right. Thank you.
Have a
Bill.
good weekend.
Have a good week. Bye.
So you've been listening to Bill Bullington and Mike Seeger here on 1420. You guys can pick up this as a podcast on 955thefish.com or bullingtoncapital.com. Have a good week, good investing, good luck, and thanks again, Mike, for showing up.
Thanks for having me.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420. The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.